Hi everyone, welcome back to the channel. Today I am back with part 3rd of our basic accounting terms. In case you missed part 1st and 2nd, I have provided the link in the description. You can watch it from there. Now let's start today's video. Let's begin with entity. All the main players in our economy who play a major role in performing economic activities related to trade and commerce are collectively called as entities or business entities, and in particular, an entity. An entity is like the main character in the economic structure of any country, like big companies such as Apple Incorporation, Reliance Industries, Tata Group, etc. Event. An event is the result of any activity or occasion performed by an entity. It could be something internal, like use of raw materials for production, which results into finished goods. Unlike a transaction, event requires only one party to operate. Plus, it only involves qualitative changes, like depreciation on assets, and not quantitative, like purchase of goods for cash or credit. Voucher. A voucher is a documentary evidence in support of a transaction. For example, think of cash memos for cash purchases or purchase invoices for credit purchases. Vouchers are the basis of any transaction to be recorded in the books of accounts, like journal, subjournal, etc. Entry. Any record passed in the books of accounts, such as a journal entry against a transaction performed, is known as an entry. To pass an entry, vouchers act as the basis. In absence of vouchers, entry can't be passed. If accidentally passed, such entry will not be considered as valid. Account. An account is like a summary of business transactions related to people, property, expenses, and incomes. All transactions, along with their date of occurrence, are included in different accounts. Every account has two sides. On the left hand side is debit side, and on the right hand side is credit side. Revenue. The amount charged by the business for the goods sold or services rendered is called revenue. It is the positive energy that adds to business's capital and assets. Whether it's from selling goods or earning interest on investments, it all contributes to the business's well-being. Profit. The excess of revenue over expenses is called profit. It's like the reward for business's efforts and always makes the owner happy by increasing his or her equity. The net profit earned is always added to capital on the liability side of the balance sheet of a particular business entity. Loss. The excess of expenses over revenues is called loss. It's like a setback that decreases the owner's equity. More precisely, loss is an unwanted burden on the business which does not generate any revenue for the business. Loss is either normal or abnormal. Loss due to inherent nature of product like shrinkage, evaporation, etc. is normal, and due to some mishappening like fire, theft, flood, etc. is abnormal. Income. Income is the increase in benefits that a business entity gets during a certain time period. It could be an inflow of assets or a decrease in liabilities, which adds to business value, that is internal equity, other than those relating to contribution from equity participants. Gain. Gain is an irregular profit, like making money from selling a big asset. It can be short term or long term, based on how long the asset has been with the business. Discount. Discount is the special deal offered by the businesses to customers. Discount can be off trade or cash. The price cuts during a sale is called trade discount, while rewards given to customers for quick payments is called cash discount. That's all for this video. If you found it useful, give it a like, share it with others, and please subscribe to my YouTube channel. Press the bell icon for future notifications. Until next time, keep learning and exploring. See you in next video.